Welcome to Risk and Rewards. There is one theme only this week. It is jobs, jobs, jobs. They came in very strong, at least Abramowicz, John Authers, also with me. And together we are going to look at, again, the only thing that people can talk about, the labor market, which appears to be running hot. 943,000 was the number on the monthly July jobs report, far hotter than expectations, indicating what we already knew, a strong labor market, but just confirming the anecdotes, John.
Yes, and I suspect we're going to be mentioning quite a lot of anecdotes. Neither of us believes that data is the plural of anecdote, but these are very, very strange times, and it behoves anybody who is looking at the numbers quantitatively also to make a qualitative judgment about the world around them, because there are plainly ways in which this recovery, this growth in employment, is very different from anything else in living memory.
So as you said, anecdotes don't make data. However, they do give a flavor. And you were just on vacation. I was just on vacation. One thing that we both saw, a lot of help wanted signs. As you said, there is something afoot. How do you translate that into what we are seeing in the data and what we can expect to see?
Well, the critical point, and I've literally never seen as many help wanted signs as I've done in the week I was on vacation. It's just, they hit you in the face almost literally everywhere you go. I think the critical point, where we really see where the rubber hits the road, is in the labor market, in wages, in whether this is ultimately going to mean that employers throw in the towel and pay more to employees, or whether this is more of a transitory phenomenon or even a lifestyle phenomenon where people are deciding that they've got better things to do than work 9 to 5 or 7 to 9 as a wage slave, and are looking for some way different to run their lives.
One of the reasons why I love speaking with you, John, is because you also like the behavioral economics aspect of the market. And that's essentially what we're looking at. And what we don't understand, and the mystery underpinning it, is, do people want more money? Do people have the inability to go back to work for health reasons or for childcare? Or is there this sea change that you're talking about, where people are saying money isn't enough? I want to work from home, and I don't care if I take a pay cut. I want to basically have a job that gives me the life that I want, wherever it may be. And we have seen that again and again. Anecdotally, we saw a 4% year over year increase in wages in this latest labor market. And anecdotally, Walmart's offering $200 bonuses to warehouse workers a week just to stay in their seats during August. Target paying their education salaries for their employees. At what point does this lead to something that has stickiness, right? That has a persistent character to it? And that still remains the question, John.
Yes, it does. I guess as contracts tend to be annual, and also as leases tend to be annual, it's as those contracts get renegotiated, if we do have a wave of relatively lower paid people. I mean, Amazon stole their thunder in recent years, but at one point, low paid workers for Walmart was a huge social issue. It was one of the great things that exercised people on the left of American politics, and certainly not totally without reason. If one of the reasonable lessons from history about pandemics, not that we've had too many pandemics that are exactly like this one, was that it does tend to strengthen the hand of labor compared to capital. Capital has been doing very well compared to labor ever since Reagan or Thatcher elsewhere. In most of the Western world, it always seemed quite an appealing notion, in terms of the broad historical sweep, that you would see a strengthening of the hand of labor, higher wages, and therefore a return to something more like secular inflation. Can one look at this week's report or my vacation observations and decide that we're absolutely confident about grand cycles of history? Of course not. If you do, but in terms of the stickiness, the economic comments of the stickiness, if in the next 3 or 4 months, lots of companies do return to full force and swallow hard and pay people more to do so on contracts that last for at least a year, that's going to begin to become sticky.
You mentioned rents, and there was one of the biggest rental owners in the country actually increased rents by 8% in April alone earlier this year. There has been a marked increase in just the basic cost of living. And frankly, even a 4% year over year wage increase, albeit not a perfect measure because it's not necessarily weighted perfectly to the economy in the same kind of apples to apples way, is far below that 8% increase that we saw in that 1 month, right? So it's not keeping pace, even though these are bigger numbers than we've seen in a long time, which is the reason why over the past week, I saw so many notes that said stagflation, right? People started to talk about that a little bit more, that yes, you're going to get increases in inflation, but it will slow growth long term. And that has been what we've seen in the bond market. I mean, even today, the reaction to this hotter than expected labor market report was relatively muted, frankly. And yes, you saw the 10-year yield rise, but the yield curve didn't steepen that much. Yeah, a little bit, but it wasn't a dramatic move, even as more people say tapering the bond purchases of the Federal Reserve is very much on the table.
Okay, I will add one. I agree with your analysis. I would add one asterisk, which is the 10-year TIPS yield, which is now up 18 bips in 3 days. Coincidentally, it was up 18 bips on FOMC day in June, which was the last big hawkish shock we received, or the last moment people thought, oh, maybe the Fed isn't going to be easy forever, and maybe we do need to see rates start to rise. That said, again, real yields are still lower now than they were before the June FOMC, having been to historic lows earlier this week. But yeah, anyway, at the very extremes, you can see some greater movement on bond yields. But yes, it's still the case that we have negative real yields, more than -1%. We are still in a situation where we're not exactly taper tantruming or braced for any kind of a tightening in money.
I like the taper tantruming is a verb. One thing that I wanted to ask your view on, because this is something that I've heard from a growing number of analysts, that, yes, you do have a lower supply of workers than the demand right now. And that speaks to the help wanted ads. It speaks to the JOLTS numbers that we've gotten, the job openings numbers that we've gotten. How much does this accelerate the shift to automation? Right. How much does this shift in acceleration away from human capital because it is less reliable or too expensive, to use a corporate terminology, not necessarily notwithstanding the humanity of it all? I have heard anecdotally this ongoing. And at what point does this even out and create sort of a balance that's a little less favorable for labor than perhaps in the past?
Oh, that's fascinating. I mean, it's another Arnold Toynbee question, which we'll be able to answer with some confidence a generation from now or whatever. I again, on an anecdotal level, I worry that automation in quite a number of industries has gone about as far as it can for a while, that AI and so on needs to get a lot better before they can move much more away from human interaction. I guess one other point that's worth making, because it's still unclear, is exactly how everybody's had this eureka moment that maybe they can work from home and that they like to work from home and they don't see why they shouldn't work from home. My next anecdote, I'm very proud of this one because it's quite extraordinary. On successive days, I had an email from the university, your alma mater, right? University of Chicago, saying that they had done a survey that found that more than 10% of people would quit forthwith without a job to go to if they didn't, if they were told by their employer they had to come back to work straight away 5 days a week, and another third would immediately start looking. And then the next day I got a report from a big HR consultancy saying that people would take a wage cut of up to a third in return from being allowed to stay working from home. So there is obviously this huge new dynamic in the personal choices we're all making. But it's not clear whether that will translate into people actually taking less money and a big improvement in productivity as companies don't need to have their offices, blah, 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 or whether it leads to workers just getting much more self-confident and feeling much more able to be aggressive in their negotiations. It's about behavioral economics. I wish I knew the answer, but that's the question.
And I suspect that a disproportionate number of those people, and again, I am speculating here, are women who have children at home who find that they can be available to their children more easily if they are closer to home, closer to their schools. Yeah. And I wonder how much this is going to shift the balance there, or perhaps exacerbate some of the differences there going forward. I find that fascinating because that has not recovered yet. And we continue to see some of those disparities that really were accentuated during the pandemic continue. All right, we have about 5 minutes left. And I do want to get to the sense of where the market surprises could be, or where you're seeing the balance of risks shift as a result of the stronger labor market data. I know that you've been particularly optimistic about inflation picking up, about wages. I'm wondering whether this sort of gives you steam and makes you think that we're going to lead toward higher bond yields and also something more imminent rather than just sort of a long-term trend.
Okay. Now, first of all, I've trodden on this rake more than once before of saying short bonds. And as I have urged people to do something that would have lost them a lot of money by going short bonds more than once in the past, you're free to ignore me. I cannot see how this degree of strength we're seeing. Everything we all know, this absent delta being towards the worst end of expectations, which I don't feel like trying to assess at the present. But absent that, I cannot see any sense at all in a negative real yield of more than -1% for 10-year money. I would definitely, I would take profits on your tips if I were you. Anyone out there who has any freedom in the matter of whether they keep holding tips or not. In terms of stocks, it's quite interesting that a lot of the bigger industrials, if you really believe that there is an industrial move, or that there is a classic cyclical recovery buried beneath the immense noise of the human health recovery from the pandemic, then there's a lot of very interestingly underpriced industrial companies where their earnings still haven't recovered as much as others.
Wait,
so that's my basic hunch, which may well be wrong.
Okay, let's start with yields. That you think that they are going to rise, and that tips certainly a place to take profits. I'm looking right now at a firm called Alphadyne Asset Management, which lost more than $1 billion in its $12 billion macro fund on short bond bets. And, this is a fund that had actually done very well. This has been absolute pain trade for a lot of macro hedge funds. This idea that it should seem like bond yields rise, given the macroeconomic backdrop and real yields being so negative, doesn't make sense. Here's the one counter argument, and I keep coming back to this. Even if we get really good employment numbers, the fact that the U.S. Treasury Department is selling fewer treasuries going forward, fewer coupon notes, the fact that they're actually reducing supply coming into the market because the refunding is they have enough money in the bank, right? Paired with this idea that I can't imagine the Fed actually shrinking their balance sheet. I don't understand how they could get to that point. Tapering bond purchase is one thing, sure, but that still leads to a higher balance sheet. And it's right now at $8.2 trillion. So if they keep increasing their purchases and you have lower bond sales, just by math, that keeps a finger on the market, the finger on yields, suppressing them for a long time.
Yes, I would agree with that. I had a headline, having been a Queen fan back in the day, I had a headline just before the Powell pivot in December, 2018, quantitative tightening, very, very frightening. The market finds quantitative tightening, i.e. actually shrinking the Fed balance, very frightening indeed. They completely freaked on Christmas Eve 2018, and that will be, I'm sure, a big point in big argument, big concern in Mr. Powell's mind. Yes, the basics of supply and demand within the bond market are difficult to get away from. The the whole TGA, the whole Treasury account that they put to one side last year has clouded a lot of calculations. And yeah, okay, we're also getting an infrastructure deal, but much smaller than some people sometimes thought. Those are all reasons to be cautious about shorting bonds in line with what I just suggested. There were also plenty of good reasons to be cautious about buying value in 2000 at a point when a number of great fund managers had been forced out of business by doing value. Timing is painful and crucial in all of these things. I still wouldn't bet on it.
Yeah, well,
again, bet on yields staying at more than -1% for 10 years, forever, real terms.
Well, you've got some very good company, and the argument is well taken, especially as we see all of those help wanted signs and we see wages increase materially in line with so many other things that we buy every day. Unfortunately, we're out of time. I want to talk with you someday, just take a long form view on how people have changed their view about what quality of life means, but that is not the venue right here, right now. And so have a wonderful, wonderful weekend. And till next Friday.